Hi students, good evening again. Today we are going to discuss the concept of the bank reconciliation statement. Okay. In the previous lectures we have discussed about the journal entries, we have discussed about that how to prepare the trial balance and all the things, and in the previous lecture we have discussed about the cash book, and we discussed the transaction related to the bank, the two-column cash book, or what we call as a double-column cash book. So how to maintain that one, and what are the main transactions that we can record in the cash books, how they are recorded. So today we will record or discuss the concept of bank reconciliation statement. Now, the bank reconciliation statement, what is the meaning of the bank reconciliation statement, why we need the bank reconciliation statement, and what is the purpose and how it is prepared. So all these things we will discuss today. Okay, first of all, why we need the bank reconciliation statement. Okay, see, we have a cash account, we have a bank account, means some of the cash is available like cash in hand, some of the cash available in the bank. Okay, and then we have these both things recording where in the cash book. Yesterday we have discussed that one, the cash book with the two columns, where we have a cash account or cash in hand account column was there, and cash at bank account column was there. So if we combine these two, we have what? We have the cash book, where all the transactions related to the cash at bank are there, how much is the receipt, how much is the payments, all the transactions are there. Okay. Now, one more thing that we have is the bank statement. Now, what is the bank statement? Or in the previous, you can say like about 20 or 30 years back, it was called as the passbook, but now it is commonly known as the bank statement. What is the bank statement? Obviously, if you are maintaining the record of your cash at bank, the bank is also maintaining your record. Why they are maintaining the record? Because they have hundreds or thousands of the different account holders are there, so they have to know that how much is the available balance for Mr. A, for Mr. B, for Mr. C, XYZ, how many, maybe thousands of customers are there, thousands of the account holders are there. So they have to know that what is the balance of any specific person or any specific business. For example, your business is there and you deposit the money into the bank, so they maintain all your record, and after some time, it may be on the monthly basis or it may be on the yearly basis, they send you the hard copy of the bank statement. Or now a bit advancement is there, so what happens, even you have a mobile phone or you have internet banking, so immediately within a seconds you can check your bank statement, that how much is increasing in the bank, how much is decreasing, how much you have deposited, how much is withdrawn. So all the transactions can be easily verified and can checked from the bank statement. So this is the record maintained by whom? Your record, your bank account maintained by the bank, so that will be in the bank statement. And then we have the bank account, where in the cash book, so you are recording all the transactions, we are recording all the debits, all the credits, all receipt, all payments. So this is what this is maintained by the account holder. So who is preparing the cash book? The account holder is preparing the cash book, and they are writing all the debits, all the credits, means all the receipts, all the payment, the opening balance, the closing balance. So all these things are recorded by the account holder. And who is preparing or who is maintaining the bank statement? Obviously, the bank. So whenever you deposit the money into the bank, obviously you are writing on the debit side. So for you it is asset, but again the bank will also write it, but not as a debit, as a credit, because it is asset for you, but for the bank it is a liability. So any transaction you are recording here, for example, you are depositing the check into the bank account. So what will happen? You have received that check from the customer. So the bank account will be debit for example, $2,000, okay, that will be debit. And then, for example, you have an account receivable, Mr. X is there, so that will 2,000 will be credit. Means you have received the money from the customer in the form of the check, and you have deposited that check into the bank, so you have increased your bank account with the debit. So this is what, this is the asset for the business, because this money is available in the bank for you, so you have deposited that one, so it means the bank account is debited, so your asset is increasing. Okay, but what will be the effect of this thing in your bank statement? Means what record the bank will be maintaining. Bank is receiving what? Bank is receiving the cash, so the cash account will be debit, and then the customer account. Customer account means account holder, for example 1005, so that will be credit with 2,000. So the customer account is credited, means for this is what, this is the liability for the bank. So bank is receiving the cash, or you are depositing directly when your customer is depositing the money into the bank, so your bank account is debited and account receivable is credited. But here the bank is also maintaining that record, so bank will record it what the cash they are receiving will be debited, and because it is the liability, it is liability for the bank. Because why liability for the bank? Because this is your money, it's not bank's money, so you have just given that money for the safety purposes or for the investment purposes or any other purpose to the bank, so it is a liability for the bank, so that's why for you it is debit, but for the bank it is credit, it is a liability. For you it is like a business, for the business it is a debit or the asset, but for the bank it is the liability, or what we say, it is the payable for the bank. So it means normally when you deposit the money or someone else deposits the money into your bank account or in your business account, you receive a message from the bank that money has been credited in your account. So that's why bank is increasing their liability, so that's why they are crediting the money into the bank account. So this is the basic thing that we have to understand, that what is the transaction in the bank, what is the transaction in the bank account, or how bank is maintaining the record. In the same way, for example, you are withdrawing the money from the bank, so what will happen, you are giving like a payment to someone, or you have issued the check, or you have withdrawn the money for any purpose, so what will happen, your bank account will be credit, but bank will debit that one. We just do that transaction also. For example, the cash account mean cash in hand account is debit, let's say 1,000, and from where you are withdrawing the money? From the bank, so the bank account will be credit by 1,000. So cash in hand is increasing, so you are withdrawing the money from the bank, so cash in hand is increasing, but your bank account, your asset account, the bank account asset, the current asset, that is decreasing by 1,000. But how the bank will be treating that transaction? So now here the customer account and the account holder, which account holder? 1005 will be debit by how much? 1,000, and bank's cash is credited with 1,000. Now the liability of the bank is reducing, so that's why bank will send you a message when you are getting some SMS or the WhatsApp message. So what is that message? Your bank account has been debited, because you have withdrawn the money from the bank account, so they send you the message, you have been debited, so your account has been debited. So it means what? It means that your balance is reducing, the bank's liability is reducing, so that's why what they are doing, they are debiting this thing. So here for you it is a credit, but for the bank it is a debit. So this is the basic concept, that how all the transactions are recorded in your account, in the account holder, and then how the bank maintain your bank statement, how they increase the value, how they decrease the value. So this is the basic concept of the transactions which are recorded as in the cash book, and how the transactions are recorded in the bank statement. So we have discussed about that how the customer or the account holder is maintaining the account. So what is the debit, what is the credit, and how bank is maintaining the same record into the bank statement. So now if you see here, whatsoever you're debiting, the bank is crediting, whatsoever you're crediting, the bank is debiting. It means every transaction that you are recording is also recorded by the bank. So if it is like that, so any transaction you are recording, so it is recorded by the bank also. Any recording that the bank is doing, so you are also recording. So it means when you have a balance of your cash book, the bank account balance, and then at the end of the month, end of the year, the bank statement is also issued by the bank. So the balance, both balances should be equal. But normally there is a difference. Why there is a difference? We have to find out that difference. And then we have to prepare a bank reconciliation statement. Who has to prepare? The business has to, the businessman or the account holder has to prepare the bank reconciliation statement. So who has prepared the cash book? The account holder. Who has prepared the bank statement? Bank. Who is maintaining that one? The bank. And who has to prepare the bank reconciliation statement? The account holder. Because if there is a difference, for example, the balance here is, let's say, $25,000. You are maintaining all the transactions, debit, credit, all receipts, all payment you are recording. At the end of the month, you have seen that the total balance is the debit balance of $25,000 in your account. But you are receiving a statement, for example, from the bank, and they are showing that no, your account balance is, let's say, $24,600 as a credit balance. Means this is the balance available with you in the bank. Now, it means what? It means that there is some difference. You have recorded all the transaction, the bank has recorded all the transaction, but still there is a difference. Why that difference exists? Okay, to have to find the difference, and then what we have to do? We have to prepare a bank reconciliation statement to see that we have to reach from here to here or from here to here. Means either we are agreeing the balance of the cash book with the bank statement, or if we are starting with the balance of the bank statement, we will adjust it, or we will not adjust, sorry, we will manage it to make it reconcile it with the bank account, so of 25,000. So we have to find out that why there is a $600 difference is there. It may be due to one reason, maybe due to two reasons, three reasons. So there are so many reasons why the difference in the account, the bank statement, and the cash book, the bank balance account is different. So we have to find those reasons, we have to find those differences, and then we have to prepare a bank reconciliation statement. Means from here we will reach here in this way, or from that, if we are starting from the 24,500, we will reach at the 25,000. So we will reconcile it, we will manage to find out the differences. So this is why the bank reconciliation statement is prepared. So what are the reasons why there is a difference? So now we will discuss what are the reasons why there is a debit difference or credit difference, why there is a more or less amounts are recorded. So those information we will record here.